Hi, this is Nate Williams, and I'm excited to talk about a misunderstood tax deduction, cost segregation for real estate. This is one that we hear a lot of. This gets a lot of press in the social media circles and the blogosphere or whatever, wherever people are getting their information from tax experts and real estate promoters. So, we're going to talk about what cost segregation really is and is it a real thing and should you do it? So cost segregation is a real benefit. It's a real tax deduction. It's a real thing. Yes. The myth is that if you do a cost seg study, then there are huge tax breaks for buying real estate. And so this is promoted by CPAs and real estate promoters alike. That if you do this cost seg study, it's so amazing that you should invest in real estate because of this tax deduction alone. Not to mention, real estate is so awesome as an investment. Here's the fact. The fact is that every business asset you buy, with the exception of land, is tax deductible under normal depreciation laws, including real estate. Cost segregation does not save you a dime in taxes. Let me repeat that. Cost segregation does not save you a dime in taxes. All it does is accelerate some of the deductions you can get on the real estate. I'll explain how it works. If you buy a piece of commercial property, like a building, the depreciable life of a commercial building is 39 years. Some of the things that you buy inside of that building, like if it's a dental practice, maybe some of the dental plumbing or some of the dental cabinetry or the carpet, some of those things have different depreciable lives. They're different asset classes as from a depreciation standpoint. And so what the IRS allows you to do is to go in and do a study and say, there's the whole building, but these certain items are not part of the larger building. They're separately identifiable and separately depreciable items. And some of them, in fact, all of them, that's why we're doing the study, have a faster depreciation life. So the key with cost segregation is you can depreciate certain things faster than others. And that's the key. So here's an example, and here's how it works again. Let's say you buy a building and land for $1.5 million. The land gets allocated $500,000 and the building $1 million, just for the sake of this example. What's the depreciable life on the land? Nothing, never. You don't depreciate land. The building has a 39-year depreciable life. So your depreciation per year is $25,641. And you get to depreciate that for 39 years for a total depreciation of $1 million. But let's say you did a cost segregation study, and with this amazing study that we said, okay, the land again is $500,000, but the building is only $700,000. Then there are 5-year assets and even Section 179 assets. Now, I'm not listing out what these are, but 5-year assets would be you depreciate them over 5 years. Section 179 assets are certain things that you can deduct in the year that you purchase it. And let's just say that the person who does the cost segregation study allocates $200,000 to 5-year assets and $100,000 to Section 179 assets. So these things have a depreciable life of 5 years, and this has a depreciable life of 1 year. So with the cost segregation study, in year one, you get depreciation of $157,949. That's really exciting, right? And then in years 2 through 5, you get depreciation of $57,949. That's also exciting. But once that initial party is over, then the depreciation for year 6 through 39 is $17,949 per year. The thing to note is that total depreciation is still $1 million, okay? So in the long run, you didn't save any money. You get the same tax deduction either way. So question, is cost segregation a good thing? Um, Here's the normal depreciation. Years 1 through 5, you get to depreciate $128,205. And this is in my prior example. So it's that 1 year depreciation times 5 years. So the total taxes saved, $47,439. And depreciation years 6 through 39, total is $871,795 of depreciation. And here's the taxes saved. So the total depreciation is a million. Total taxes saved, $370,000. With the cost segregation, again, you're getting the total depreciation the same, total taxes saved are the same over the life of the building, but you're saving $144,000 in taxes for the first 5 years. So that's a savings of $96,770 in year 1 through 5. But then you're going to lose that over years 6 through 39. Does that make sense? All you're doing with cost segregation is taking the depreciation schedule, which is this long flat curve, and you're pulling some of it forward. That's all you're doing. So the question is this a good idea? Should you pay for a cost segregation study on a real estate purchase? If this is a good idea, it depends on what you do with the cash in the first 5 years. If you can invest the extra cash in the first 5 years or pay off the debt on the property, accelerate the debt payment, then perhaps the cost segregation is worth it. But you should never invest in, but I want to get to this point next. But if you're going to take the extra savings and then just spend that money, then you probably didn't get anywhere with the cost segregation. All you did is you had a big party early and you're going to pay for it in the long run. The other thing I want to emphasize is you should never, ever, ever invest in real estate for the sole purpose of getting a tax deduction by way of a cost segregation study. I know that a lot of people promote this. Hey, invest in real estate because it's got these amazing tax breaks. No, it doesn't. It's just normal depreciation like any business asset. And a cost segregation study allows you to accelerate it a little bit, but you should not be making the decision because of this. That's something that we're very consistent on. Do not make an economic business decision based on a so-called or hoped for tax deduction. I hope that's helpful. I hope you can understand the cost segregation study a little bit more.